the owners that either have no debt or have a low basis, they're buying deals. They're just buying occupancy to live to fight another day. And there's actually been a couple of acquisitions recently in the IE that where their business plan is, we're going to buy this at a great basis and we're going to do a really cheap, ugly deal for 2 or 3 years.
Welcome to our Industrial Advisors podcast. You have Bill Condon and Matt McGregor, and we have Mike Kendall joining us today. Mike leads our investment team on the West Coast for industrial at Colliers and does a great job, has a great pulse on kind of everything investment-wise that is going on the West Coast. So, Mike, thanks for joining us again. I think this is probably your, third time joining us on this podcast.
I think so. Hi, guys. Thanks for having me again.
Welcome.
Thank you.
Absolutely.
Appreciate it.
By the way, Mike, you don't know this, but your last show trended our most listened podcast in 2024.
Wow, look at that.
Yeah.
No pressure though, right?
That's right.
Everybody was wondering what was going on in 24, right? So,
yeah, where are all the sales?
Yeah, so let's talk about 2024. How about just giving us kind of a high level overview of what happened in 2024 across the West Coast from an investment standpoint on the industrial side?
Yeah, so 24 was basically like the mirror image of 23, kind of the opposite. So 23, first half of the year, quite strong. Second half of the year, sales fell off a cliff. And that was the beginning of the volatility of the 10-year and kind of the rise of inflation. And so 24, that volatility that reared its ugly head at the second half of 23 continued into 24. And so volume in the first half of 24 was still off pretty considerably. And then things picked up. And actually the second half of the year was pretty good from a volume standpoint, from my team's perspective, especially. We had a good second half of the year. Overall, from my team's perspective, I think we're a pretty good proxy for the overall market. Our volume was up over 23 volume about 15%. 23 volume was down about 35% from 22. So we're not back to 22 volume yet, which was everyone's kind of best year was 22 in our business. But I do expect 25 to be, again, slightly better than 24. So we're trending in the right direction, but not without its struggles, which we'll certainly get into.
You talk about the numbers on the whole Western region. Let's talk a little bit specifically about Seattle. So 2024 was actually a good year. We bounced back about 2.5 times the volume of 2023 for just under 1.2 billion. And the average per square foot was 233 through Q1. This was a very good Q1 here for just under 250 million, 7 transactions, but a big drop, Mike, as we discussed on per square foot down to 201. Are you seeing that kind of across the board? Is that kind of a drop?
We are. Yeah, we're seeing, and what's really driving that is the weakening leasing fundamentals. Rents are falling, and we all know what happens when rents fall. Obviously, that income is capped, and so that's caused quite a bit of deterioration in value. And it's not equal across all the markets. For instance, Las Vegas is a good example. We have a couple of I would call them notable portfolios on the market today that really give us a finger on the pulse. We have a 1 million square foot portfolio in Vegas for Link. We have a 2 million square foot portfolio for CenterPoint in the Central Valley. And the leasing fundamentals in Vegas have weakened. They held up better kind of through 24 than a lot of other markets. And so capital interest in Vegas was very strong in 24. But fast forward into 25, there's still a lot of interest in Vegas. Everyone likes the market long term. But with the decline in rents and decline in leasing velocity, especially in North Las Vegas, investors are building in a little more safety into their underwriting. And so that's pushing values down. And same thing has happened in the Inland Empire. That's kind of the bellwether for the whole West Coast. Rents have fallen in the IE probably more than anywhere else in the country. And so that's pushed values down dramatically. our team set the high water comp in the Inland Empire in early 23. And actually, no, I'm sorry, mid 22 was the closing of these two deals. And they were both, one was $525 a foot, one was $527.
Wow.
And that amazing. You can pin that as the absolute peak of the market.
Wow.
And those buildings, especially one of them was a user sale, so a little bit of an asterisk. The other one, the $525 a foot, Coca-Cola leased in the IE West in Fontana. If that building were brought to market today with the same lease in place, same everything, instead of $525 a foot, it's probably a $300 a foot building.
Wow.
I would have guessed that number. When you were saying that, I bet I was thinking it's probably a $300.
Yeah, and it might even be high twos. And so that's what's happened. And it's all based on market rent. We peaked in the market at market rent of maybe $1.80 for the best of the best in the West. And now everything's now gone to gross. And so when you do a net equivalent in the West, maybe you're at $1.10 from $1.80. So you do the math. That's a pretty big drop. And in the East, we went from $1.40 down to 80 cents. So it's, so that's a direct translation to values. When people, I like to say that the risk pendulum has swung kind of too far over, and investors right now, in my opinion, are overpricing risk. And that could be credit risk, that could be vacancy risk, that could be kind of locational or functionality risk. Anything to do with risk, they're building in a lot of safety. And so that's directly translating to lower values.
And what markets on the West would you say are really driving the interest from the investors? Where are people getting excited?
Well, so it comes back to a couple of things. Number one, leasing fundamentals. And so as an example, Portland right now, and you guys know, because Portland always drafts off of Seattle, Portland has the second lowest vacancy rate of the whole West Coast behind LA. And then when you dive into certain submarkets in Portland, some of them are down to 2%. And so Portland is actually doing quite well. And we actually have a property on the market in Portland with Jerry Mattson, a brand new Class A building, 10-year lease in Hillsborough. So, and it's getting really good traction, good engagement with the investors because the leasing fundamentals are strong and healthy. And we're not seeing rent declines. We're still seeing rent growing in Portland. So that's an example of a market that is on a lot of people's radar because of that. The East Bay in Northern California, also very desirable. Rents did not grow as much there as they did in Southern California. So they really haven't, they've softened. They're not growing again. They maybe fallen a little bit, but not anywhere near Southern California rent. So the East Bay is also on everyone's shopping list. Pretty much every investor is underweighted kind of East Bay infill Northern California. Reno is suffering some of the same challenges from a leasing perspective that Vegas is. And so there's a lot of interest in Reno and Vegas, but just at a different price point, I would say. Phoenix is actually performing quite well. Phoenix really in the last couple of years has definitely moved from a secondary to a primary market. It's now over 600 million feet. So it's the same size as the Inland Empire and growing. They're adding more space there than they are in the IE, more leasing activity and net absorption there in the last 2 years than the Inland Empire. So it's been interesting to kind of watch that transition in front of our eyes.
Yeah, there's certainly a lot of construction going on there in Phoenix. I'm curious, we over the past few years, short-term WALT was always where the most aggressive money was chasing, right? Have you seen that shift at all from investors to wanting some more stability now with vacancy rates being up?
There's still the most money out there is definitely value add. There's just a lot of value add capital that wants to place. The interesting thing to watch is value add can be very different depending on who you're talking to. We have seen, the traditional value add money is kind of mid to upper teens on a levered IRR, probably tending more towards the mid, 15, 16%. But we've talked to some investors who have value add capital that are solving to an 11 or a 12 on a levered IRR. So that to me is more core plus, but they're calling it value add. So you really have to lift up the hood and really dig into it to really understand what people want. But to answer your question another way, they still like that shorter term WALT story, 2 to 3 year WALT. I would say 3 is better than 2. depending on the markets, because right now, if you're in a soft leasing environment, 2 years isn't enough to kind of get through the softness. But 3 is good. 3 to 4 is actually probably the best WALT right now. But again, depending on the submarket and depending on the size of the buildings, the leasing assumptions are getting more conservative. That's where people are building the safety into their numbers is, hey, if I can buy this at this number below replacement cost, I have adequate lease up time frame and adequate dollars for free rent and TIs and everything, I'll buy it.
Yep. We're seeing that for sure.
Yeah.
And last year, to Bill's point, money was on short-term WALT, and it seemed like nobody wanted a long-term lease. How does that look for leases that are 8 to say 12 years or longer? Is there money back in that segment at all?
There is. And so there's 2 different profiles of deals that kind of have that characteristic. One would be core, Class A at market rent with, 8 to 15 years of lease term. There is some core money out that is looking for that. Credit matters again. And so if you have credit and you have Class A and you're in a good market, so that's the caveat is the core money right now, by its very nature, is the most conservative capital, are very focused on certain very safe markets in their opinion. So, very infill, high barriers to entry, highly desirable primary markets. That's where they're not straying from that strategy. And then the other bucket of capital that's targeting that type of structure is, if you have significantly below market rents, but you have a lot of lease term. Historically, the last couple of years, that's been very, very hard to capitalize. But there are some, and this is mostly, I would say, ultra high net worth family offices that have a very long-term horizon that are starting to realize that they can buy something at huge discounts to replacement cost, but they may have to wait 7, 8, 9 years to get a return that's actually accreted with debt. So, they may buy something with a 4 cap and it's below a 5 cap for 7, 8 years. That's really hard for a traditional real estate buyer to buy. But some of these family offices can, as long as they can get their total return in kind of a 12 to 15 year hold, they're getting an incredible buy, a basis buy. So, and I just talked to a group yesterday that added that capital to their one of their buckets. And I think they're going to get some interesting opportunities because of that.
And speaking of cap rates, what's your projection kind of Class A stabilized short-term WALT Class A, and then say more Class B type product?
Well, so the everything kind of prices off of core. So what would a new Class A with term at market, good credit, what would that price? And then everything prices off of that. Mm-hmm. And I would say for the core markets of Seattle, Southern California, now Phoenix, that is probably right, low 5. And there have been a couple of trades in Southern California that fit that category that were like a 5 spot on. The biggest question is really, is it at market rent? And so if it's truly at market, that's where I think it is. It's 5 to 5.25. Maybe if it's a highly unique, super infill, you could drop into the high 4s. And that's with term, mm-hmm. everything else. And then you start to look at the shorter term WALT, and it's all dependent on where that rent is to market. We're seeing some things even in the 3s. If it stabilizes in 2 or 3 years or 4 years to, a 6.5, that's kind of I would say the minimum that people need to roll it to justify the below market yield up front. And up from there, we've seen some deals that will, like the Centerpoint deal is certainly going to be a low 4 going in, but you're going to get above a 7 in year 5. So those are interesting metrics for people, especially if you can get it below replacement cost.
Yeah, Matt mentioned earlier, went through some of the stats in our market of the price per square foot being down to, call it $200 a square foot, right, in this market, which is opportunistic for certain investors, right, given where things have been. So I think there's, the first half of this year, certainly, and maybe even into the second half, there's going to be some real opportunity for investors. Where do you see some of those opportunities up and down the West Coast for investors as they're looking to place some capital?
Well, yeah, the basics matter again. And that's kind of what I see. This market is going back to basics, and Real Estate 101 credit matters again, location, functionality, all those things are important. And 3 years ago, it didn't. Everything was pricing the same, regardless of whether you had credit or not. And it was kind of a frothy, throw the underwriting out the window kind of thing. And so I think long term, it's healthy to get back to the basics. And so where are opportunities? Again, I personally think that risk is being overpriced. And so buying some vacancy in strategic locations, I think you can get a good buy there, because again, everyone is kind of overpricing that lease up risk. And so, basis is super important. You can buy a building at a really good basis, even if it's vacant. I think, and we're starting to see green shoots in leasing in certain markets. Central Valley is, was really slow in 24, especially over 100,000 feet or over 200. Now there's 4 or 5 deals kind of above 400,000 feet that are all circling, that when those things actually print, people are going to go, holy crap, this is a lot better than I thought. And so like Inland Empire, again, the epicenter of carnage from a rate decline perspective, but the volume is actually very good. And so you need that volume to kind of churn through the vacancy. I think it's going to actually bottom sooner than a lot of people think. And so right now I see some opportunity buying vacancy in the Inland Empire because of that herd mentality of people like, oh, I don't want something vacant right now. And as you all know, everything is not treated equally. So you don't need to wait for the vacancy to drop to 4% for it to have a healthy market. It's when the good stuff leases and you're left with the bad stuff. And as long as there are not a lot of good options remaining, you're going to start to see construction. And people are going to scratch their head on the surface thinking, why are people building when there's still 7% vacancy? Well, it's because the stuff that's left is not very good, and tenants want choices of good product.
Yeah, the Class A stuff definitely leases first.
For sure. And so another opportunity, I believe, is buying some land right now, as long as you have patient capital. That's the critical nature there, because it may take a little longer to absorb, but there's a definite gap in deliveries in every market across the country. And as we all know, it seems like the first ones, the early movers in turbulent times, are the ones that get rewarded. And so it's really hard right now. We do it, and we've been hired to do some equity raises on some spec development. But I do think that the ones that can buy into the story and really get in early are going to be very well paid for that.
That's well said, because we're selling a couple pieces of land right now, and I was quite surprised with how many offers came in, more than we would have on a building right now. And so clearly people are thinking the way you're thinking.
Yeah, as long as you have, again, patient money and some time.
That's right.
To make sure you're being thoughtful about it. That's where I think people are going to make a lot of money in the next cycle.
That's right. Last question for you, Mike. And I know this is up and down the West Coast. It's certainly prevalent in Seattle, where we have a ton of vacancy in the 1 to 250 range, 57 options in Seattle. And I know the Inland Empire has the same problem. How would you be advising clients right now? Would you be advising them? Obviously, to your point, people are really pricing in a lot of risk on those. So how are you advising clients that are wanting you to underwrite those buildings right now? Hold them and try to lease them, but what's your advice?
Yeah, I mean, a lot of it depends on the owner's basis. What we're seeing a lot, especially in the Inland Empire, and you're probably seeing it in Seattle too, is the owners that either have no debt or have a low basis. They're buying deals. They're just buying occupancy to live to fight another day. And there's actually been a couple of acquisitions recently in the IE where their business plan is, we're going to buy this at a great basis, and we're going to do a really cheap, ugly deal for 2 or 3 years. Mm-hmm. And then by the time that lease rolls, the market's going to be stronger, and then we're going to move the market rent up and then sell it. And so if you can, buy the deals, just get occupancy, get some cash flow, but do short term. And that's the biggest thing we're seeing. There's a lot of very savvy tenant rep brokers out there that are advising their clients to go long term on leases.
Lock them down, yeah.
And we have a lot of developers calling us with the leasing broker saying, here are some proposals. What do you think? And I keep really trying to advise them against doing a long term lease, because you're locking in that diluted value.
Right.
But they're like, but this building's been vacant for 18 months, or we're just delivering it, but there's no other deals on out there. We're getting nervous, and I'm like, do what you can, but I understand you have to cover your nut, but do whatever you can not to lock in these really low rents for long term. It's such an impact on value.
That's right. Well, as always, you are fascinating and a wealth of knowledge. We'll put your contact information in the footnotes for anybody that needs pricing on a building or some advice. Contact Mr. Kendall. He's here for you. Appreciate your time and being on the podcast, Mike. Thanks a lot.
Well, thank you guys. Always a pleasure to talk shop with you guys. Appreciate it.
Thanks, Mike. Great job.
Thanks. Have a good one.
Good job.
You too.
All right.